Ladies and gentlemen, good morning to you all. Thank you, Kevin and Mia, for the invitation and the honor that you're giving me to share our perspectives. So let me start with a disclaimer. If you were expecting me to comment on the latest port feast announced by Chinese authorities last week, I'm afraid I will have to let you down. My presentation is focusing more on the telescope rather than the microscope. And I'm trying to share a more mid to long-term perspective on how global trade is changing and what that could possibly mean for companies like you. I will cover two main points. One has to do with the reconfiguration of global trade, and the other has to do more specifically with energy transition, because I understand that most of you are active in the segment of transporting energy products. It would not be a McKinsey presentation if the slides were very simple. So let me try to clarify the message. First of all, no region is self-dependent. The world is fully interconnected. What you see on the page is effectively a matrix of the different main product types and the different regions, and there is no region which is fully blue. Blue means net exporter, red means net importer. And what we see is, depending on the product, regions depend on others to fulfill their needs. So that's message number one. Message number two, trade is traveling a lot. So from 2017 onwards, what we see is a slight continuous increase on the distance that trade is traveling. At the same time, this is not a message which is showing the change that has been happening. So distance is long, right? But we were trying to find something which is more interesting, more relevant. That's why we looked at the geopolitical distance. How do we define that? If you look at the different economies and how they vote in the UN, you actually understand that there are different clusters. There's the West cluster, which comprises mostly of US, Europe, Canada, Japan, and Korea. There's the East cluster, which comprises of Russia, China, Iran. And then there is a spectrum in the middle, which we call the mid-aligned countries, that, depending on the topic, vote slightly towards left or right. Why did we introduce this metric? Because if you look at the geopolitical distance of trade, that has been sharply decreasing. Particularly, over the past 4 years, we see that the geopolitical distance that trade is traveling is significantly smaller. If you look at the regions, the size of the bubble in the color indicate this delta. So USA, Europe, MENA, and China are trading more and more with closer geopolitical allies, which is helpful input if you think about the direction of the flows. Whereas Brazil, you see, is actually trading with not so close geopolitical allies, and this is mostly driven by the Brazil to China trade. So that's an important message I would like you to take away. Geopolitical distance is going sharply down. If we look at China, China continues to be the largest exporter globally. From 2010 to 2024, over the past 15 years, the overall trade between China and other countries has doubled. However, what is interesting to see is the composition of the trading partners. So China is trading less on a percentage basis with the US, EU, and what we call advanced Asia, which is more Japan and Korea, and more with developing countries. Okay, that's in the past. What's coming now? As we all know, US tariffs is the name of the game. We ran an analysis and we looked how many years, I think, since the 19th century. And what we observe is that the US tariffs, the effective US tariffs today, are at the highest levels they have been in nearly a century. The last time we had that level of tariffs was in the Great Depression, when President Hoover imposed tariffs to protect the local production from imported goods. 100 years. Okay, we have tariffs, so what? The response that we see from countries and economies to the tariffs and the US-China trade war can be summarized in what we call the 4 R's. The first one is rearrangement. So there is a change in terms of who's buying from whom, who's exporting to whom, a change in the direction of trade, a change in the trading partners. The second is ramp up, investment to increase production, either locally or in other countries. The fourth is replacement, so substitution of products with others that are similar. And the last one is reduction, decrease in the overall consumption of specific products. From those two, I want to focus mainly on rearrangement and production ramp-up, which I think are also very relevant for leaders like yourselves. Europe is on the winning end. Why is that? So the way to read those two graphs is the following. On the first side, what we see is what happens to the US imports, which is the first column, and the China exports, which is the second column, if US switches to countries with lowest tariffs. The second graph is exactly the same, but instead of switching to countries with lowest tariffs, switching to countries that have the highest geopolitical proximity. What we observe is the following. If the US would stop importing from China, completely stop, zero, 32% of those imports would come from Europe. 41% would be exports that they would not be exporting, so it would be internal consumption. And 15% would come from Asia-Pacific, excluding China. Now, if you look at where China would be exporting, if they were not exporting to the US, roughly 44% would be going to Europe, 20% Canada and Mexico, so non-US North and Central America, and roughly 13% in Asia-Pacific. And you see how those change when we focus on the closest geopolitical allies instead of the tariffs. The main message here is, if you believe in a world where the China-US trade is going to be significantly lower, Europe is on the winning end. Now, when we look at investments, what do we see? Announced investments are going up. So corporations are investing more to ramp up production. Now, the most interesting point in my view is the second graph, where we show the geopolitical distance of trade, which is the light blue line, which is what I showed you at the beginning. So trade is going more between geopolitical allies, so the geopolitical distance is decreasing. But what's very interesting is that the geopolitical distance of investment is decreasing at 2 to 3 times faster, which means that the investment to ramp up production is taking place in close geopolitical allies. What does that mean? If you look at the world, the way to understand this graph is effectively what is blue means that there is an increase in the net inflows of investment compared to what has happened over the past 10 years. And what's closer to purple or brown is a net decrease. So there's a significant increase in investment to ramp up production in the US, Latin America, Europe, MENA, and Asia, whereas China and the Asian region there, we see decrease in investment. Why is that? Is because non-Chinese companies are not investing more to ramp up production there, which is contrary to what was the case over the past 10 years. So localization of investment to ramp up production is something I would like you to take away. Why? Because as I said at the beginning, from a telescope view, not a microscope view, that will impact the global trade flows over the next 10 to 15 years. Now, trying to bring that to a commodity type that several of you are active in, which is energy. Those are 7 messages. I will not go through the message. I will walk you through the pages. But what I would like you to take away mainly is the following. The world is electrifying. When we look at the final energy consumption across any scenario, and those are the 3 scenarios that we model, from what we call slow evolution to the sustainable transformation, and the more we move to the right, the higher the pace of energy transition is assumed to be, the share of electricity in the end consumption is increasing. So we are moving to an electrifying world in terms of final energy consumption. Now, fossil fuels, contrary to, I don't want to say common belief, but to some belief, fossil fuels are here to stay. Fossil fuels will continue to be relevant in 2030, in 2040, in 2050, even after 2050. Of course, you see differences in terms of regions. So Asia continues to make a large part of the demand of fossil fuels. But the message I want to convey is we will have oil well beyond the 2050s. Across all the scenarios. So what you see here is the main graph is focusing on what we consider to be the base case, which is continued momentum. But also, if you look at the sustainable transformation, which is, as I will show you, a 1.9-degree pathway, we will still have fossil fuels in 2050s. Okay, what about sustainable fuels? Sustainable fuels are largely driven by regulation and incentives. Our view is that they will continue to grow in the more, I would say, accelerated energy transition scenario. We expect roughly 1 billion tons per annum by 2050. In what we consider our base case, it's closer to 600 million tons. The main point and the common point across the scenarios is that we do not accept wide adoption of sustainable fuels before 2040. And that's fuels for the industry. That's global demand. So for your understanding, that's cargoes that you would be transporting. So yes, we are going in this direction. The pace has been a bit lowered down, so it's a slower pace. And before 2040, we do not expect sustainable fuels to be a considerable amount of global trade. Gas, very interesting. When we run our projections across all regions and all scenarios, gas demand is growing. By 2030, and if you see in most scenarios, by 2040 as well, with the exception of Europe. So Europe is a bit of a different animal here that, depending on the scenario, you see a reduction of gas. But global natural gas trade is expected to increase, depending on the scenario that you believe in. So if you're closer to a slow evolution scenario, then even by 2050, you can expect natural gas demand globally to continue to increase. So I think if we were delivering this presentation 3, 4, 5 years ago, we would have a less bullish view on natural gas, which is now altered. So we feel confident to say that natural gas is going to be a relevant fuel for the next 20, 25 years. Now, all the scenarios that I showed before are scenarios that do not match the 1.5-degree pathway. So we are not modeling scenarios based on ideal situations. We are modeling scenarios based on how we believe the world is going to evolve. I just need to explain that and caveat that our sustainable transformation scenario, which was the more optimistic in terms of energy evolution, energy transition, is a 1.9-degree scenario. So if you are more towards the mindset of no, we believe it's going to be at 1.5, then whatever I said is more aggressive in terms of the outlook for sustainable fuels and less so in the outlook for fossil fuels. Our view is that we will be somewhere between the continued momentum and the sustainable transformation. So the points we mentioned before are valid. I've shared several pages and several graphs, but at the end of the day, I think there are 4 messages that I would like you to take away. The first one is global trade remains at almost peak historical levels, and there's no region which is self-sufficient. So the world will continue to trade significantly over the next 20-25 years. Trade is traveling further, so the geographic distance is continuing to increase. However, the most relevant metric is the geopolitical distance. And what we see is that the regions are trading more with closer geopolitical allies. US tariffs are at the highest level we've seen in a century. What that means, from a macro point of view, is mainly trade rearrangement, new trading counterparts, new trading routes, and ramp up in production. Very important to take into consideration. And the last point is that fossil fuels remain resilient well beyond the 2050s, with a variation in the regional trades, but overall fully resilient, and sustainable fuels gain adoption post-2040. So they continue to increase, but a wider adoption is only observed 15 years from today. What does that mean for shipping companies like you? In our view, the first thing is that your business planning should not be fully deterministic and should include an element of global trade scenario planning. We believe that will help you build more resilient strategies and adaptable going forward, both in terms of defining investment decisions that have to do with your fleet composition, but also commercial decisions that have to do with the fleet deployment. The third point is that those are not only concerns and issues of shipping companies, those are main concerns that your clients have, cargo owners, oil and gas companies, miners. So think about how you can create partnerships with them to solve for the new era, solve for the outlook. Uncertainty typically fosters partnerships to reduce the overall risk-taking. The last point, with the risk of sounding a bit repetitive and cliché, is that moving slightly away from instinct-based decisions and leveraging data that is out there, not only data that you have in your own servers and data lakes, but data that you can get that have to do with leading indicators of trade, is something that gradually should become more the norm for shipping companies. That will allow you to make more informed decisions in an era which, as we showed, will be characterized by uncertainty and will be characterized by changes compared to what we have known so far. Thank you for listening. I hope it was interesting. Thank you very much.